We're going to take a deep dive into how raising interest rates are used to tame inflation and keep the economy stable. Raising interest rates is a powerful tool that central banks use to control inflation. Inflation is the rate at which prices for goods and services increase over time. It's measured by the Consumer Price Index, or the CPI, which tracks the prices of a basket of commonly purchased items. When the CPI goes up, this means that inflation is rising, and when it comes down, that means inflation is falling. One of the main causes of inflation is too much money chasing too few goods. When there's more money in circulation, people can afford to pay more for goods and services, which drives the prices up. This is why central banks like the Federal Reserve keep a close eye on the money supply. If it starts to grow quickly, then they'll take action to slow it down. And there are many ways to slow down the money supply, but today we'll be talking about increasing interest rates. When interest rates go up, borrowing money becomes more expensive. It makes it less attractive for people and businesses to take out loans, which slows down the economy. Now, that might sound like a bad thing, but when the economy slows down, the demand for goods and services also slows down. This is good because it helps keep prices in check, which helps keep inflation in check. Another key way that raising interest rates manages inflation is by making it more attractive for people to save their money. When interest rates are high, people can earn more by keeping their money in savings accounts and other bank accounts. This helps reduce the overall money supply in circulation, which can be an effective way to curb the type of spending that can lead to inflation. In the face of decreased demand, businesses will have no choice but to keep their prices stagnant or even lower prices. This will also help to keep inflation from getting out of control. With that said, raising interest rates can have a significant impact on the economy. And while it may have the benefit of controlling inflation, it may lead to some challenges and some drawbacks. For instance, when interest rates are high, it can be extremely difficult for businesses to expand and to thrive. High interest rates make it more expensive for businesses to borrow money, which can limit their ability to invest in new equipment or technology or hire new employees. This can lead to slower growth and even stagnation for some businesses. Additionally, high interest rates make it more difficult for individuals to purchase large ticket items like homes, cars, and large appliances. Mortgages, car loans, and other types of loans become more expensive, and this can make it difficult for people to qualify for financing. This can lead to a slower housing market and a drop in consumer spending, both of which can be detrimental to an economy. High interest rates can lead to a rise in unemployment. As businesses struggle to afford a high borrowing cost, they can be forced to lay off workers and reduce their staff just to cut costs. And this eventually leads to a drop in overall economic activity. Despite these drawbacks, raising interest rates is often seen as a necessary step to control inflation. By slowing down the economy and making it more attractive to save money, raising interest rates can help to keep prices in check and keep the economy from overheating. We now understand what inflation is and how raising interest rates can help to curb inflation, but we can't successfully navigate inflation if we can't measure it. And this is where purchasing power comes in. But that will be in the next video in this series.